What's up, everybody, and welcome back to the Junior Markets YouTube channel. If you're tuning in from YouTube, please make sure to check out my website, Junior Markets. I'm going over everything in this video and more detail on REIT of the Week. And if you're tuning in from the website, this should be the video on the REIT of the Week. And the goal of this video is just to go over a REIT that I found and I saw and I think has some upward potential, and why I believe this. As always, do your own research. Don't invest purely off of this. This is not investment advice. It's just sharing information. So to get right in, the REIT we'll be going over today is Agree Realty Corp REIT. Now, the stock is currently trading at $58.65. And looking back at a 3-year chart, you can see it's down about 16%. 5-year chart, it's been pretty stationary, but we're going to get into some reasons why I think it could go up. Now, this is also during COVID, so it had a little bit of rise, and then it's dropped way far down because people haven't been going to stores and things like that. So we'll get in some more into that. So just to start off, what is Agree Realty Corp? And essentially, it is a Michigan-based net lease REIT, and it focuses on retail properties. So that means that it leases out properties to other companies, and then they use that property. So as of May 15th, the REIT's portfolio includes 1,908 properties, totaling about 40 million square feet in 48 states. And one thing that I like to look for is how do they make money. So ADC, that's their ticker, they make money by leasing their property out to their customers. So some of their customers include Walmart, Dollar General, Best Buy, Kroger, Home Depot, Lowe's, other companies like that. So these are well-known brands that are able to pay their lease. So we have no worries with that. And then looking over here, so one of the most important things for REITs is dividends. A lot of people invest in REITs because of the dividends. So again, we're back on Charles Schwab's website. And so let's get into the dividends. So as you can see, constant increases above inflation since 2016, 5, 6, 6, all the way up. And the payout ratio now is, or the annual dividend yield, I should say, is 5% with a $3 annual dividend yield. And this is a lot, and especially with these increases over the years. So, and considering REITs have to pay out at least 90% of their revenue as a dividend, this is nice. And looking down at the growth down here, we can see the 3-year growth is negative 8%. This is probably because of COVID, and they weren't receiving as much revenue because the companies they were leasing out to, such as Walmart, Home Depot, Lowe's, weren't making as much profit because no one was going out. But if we look at the 10-year growth rate, we can see that it's a 13.5%, which is very high. We like to see that. So now we are over on Yahoo Finance, and first we're going to look at the market cap. So this is a large cap stock at about $6 billion. The PE and the Ford PE are about the same. And then let's move into some other ones. So a few of the ones that I want to go over aren't on this sheet. So I'm just going to be reading them off from the website. So some of the things that I like to look at first for REITs is FFO, or funds from operations. So this is very important as this analyzes the operating performance of the REIT. So you need to look at this. And the FFO of ADC has beat estimates, and it rose 5 cents from last quarter. They posted revenues of about 150 million for the quarter ending in this March, and this surpasses expectations. And then another thing that I look at with FFO is adjusted FFO payout ratio, and this is the percentage of adjusted funds from operations, so the percentage of FFO paid out as a dividend. So a rising payout ratio means the dividend is growing faster than the cash, or that the cash flow is declining. So you want to see this probably below 90%. That's kind of a preference. And for Agree, they have regularly since 2014 kept it 78% or below. So that's a good thing that we like to see. Now, moving over into sales growth. Sales growth averages about 27% sales growth since 2014, and that's about double, almost triple the benchmark that we like to look for REITs. So that's nice. And then moving on into some more metrics, we like to look at return on invested capital. This is important because you want to see how much return this REIT is getting out of the money that they're putting in, especially because they can't really put a lot in because 90% of it has to be paid out as dividends. So the ROIC lowered from 5% to 3% in the last 10 years. So that's something that we don't want to see. So if we'd like to see that increased into the future. Now, another thing I'm going to look at right here is the beta. As you can see, 0.52. So this means it's not very volatile with the S&P 500 at 1. And then now we're going to go down to, I believe there are amount of shares on here. Percent of shares, shares held by investors, shares outstanding. Here we go. So the shares outstanding are 100 million. And so one thing that REITs have to do is regularly issue shares to help fund their growth. And this is because, again, they have to pay out 90% of their income as a dividend. So if you invest in REITs, your position will likely be regularly diluted to help fund their growth. And then the last thing I'm going to look at is I'm going to see if it's on here. Net debt. It's not. So is net debt to EBITDA. And this essentially means how many years of EBITDA, earnings before interest, taxes, depreciation, and amortization, a company would need to pay off all of its debt. So we want to look for anywhere under about 6, which would mean about 6 years. And ADC's has dropped to 4.88. So this is something that we like to see. So now we're over in the analysis tab, and if we look at the analyst price target, you can see it's about 66, up from what it's currently at, which is about 58. Another Wall Street price forecast from Seeking Alpha said about $67. So any way you look at it, there's about a 15% upside to this company. Now we can head back over to Schwab's website to finish. Back over on Schwab's website, they also maintain a price target of about $65. So looking at this stock, it'll be about a 15% upside. And then if you go in and reinvest these dividends, this could be a nice REIT to add to your portfolio, as they have big customers such as Walmart, Home Depot, and Lowe's on their properties. They're expanding their portfolio with more properties. Their dividends are increasing faster than inflation, and all of the price targets by Wall Street, Charles Schwab, Motley Fool, Yahoo Finance, these are all somewhere in the 65 to 67 range. So if you're looking at adding a REIT to your portfolio, check out Agree Realty Corp. That will be the end of this video. Again, I go over all of this on my website in writing, as well as a little bit more information. So please go check that out. And then if you're watching this on YouTube, go check out my website at Junior Markets, as well as go check it out on all of the social media platforms at Junior Markets for that as well. And thank you for watching.